Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Scott Colbert, chief economist at Commerce Trust in Kansas City, Missouri. Thank you so much for rejoining the Contrarian Investor Podcast today.
Happy to be here.
Great to have you back again. We are recording on Thursday, March 6th, and a lot has happened here over the recent couple of days and weeks. But the long and short of it is we are curious about the state of the economic cycle, especially in light of the tariffs, some of which have now gone into effect. And your view here is a little contrarian in that you aren't quite buying all the doom and gloom that we've gotten, and you think the economy is still mid-cycle, still in decent shape, and can even stomach the tariffs. Is that right?
Yeah, I think that's a pretty accurate assessment. We're certainly going into this tariff barrage, and of course, what I used to call the policy fog from the new administration to kind of and I'm trying to be apolitical about it, the Trump trauma of, taking all this in at the same time for the business community. But I think that we will come out the other side with slower growth, lower economic activity, near-term higher inflation, but that it's likely to just be temporary. And I hate to use the word transitional because the last time inflation clearly was not transitional, but I think this largely will be absorbed over time, and then we'll be making forward progress again, recognizing that the administration has a short timeline, probably less than 2 years, to get done what it is they want to get done. And of course, they went in with a plan. That plan includes tariffs. The tariffs are largely focused on three things, and it's also kind of important to remember why we've even got them. Number one, he wants to raise some revenue so he can extend his tax cuts. That's number one. Number two, he wants to negotiate for certain things with certain trading partners. Clearly with Mexico, it has a lot to do with the border, has a lot to do with fentanyl. And with Canada, it has a lot to do with the automotive industry and perhaps timber and maybe even a little less oil and gas. Those are the negotiating types. But with China, it has to do with economic security. And as far as he's concerned, he just assumed we have no trading with China whatsoever. Thus, the tariffs on China are going to ratchet up and stick. I think the tariffs on our trading partners like Europe, or at least our friends, are malleable and hopefully modifiable. But nonetheless, he needs some revenue, and he wants to bring some jobs back here. So those are the two kind of things he's trying to balance.
Now, China is a pretty big trading partner. Aren't they our third biggest?
Well, so our three largest trading partners are roughly equal. We import approximately 14% of our goods and services. The top three trading partners, almost identically, we import 2% of our GDP from China, Mexico, and Canada, almost identical. So think of it as 2, 2, and 2. Mexico's the largest, China's the second largest, and Canada's the third largest, but collectively about 6% of the 14. So whatever 6 divided by 14 is, something a little less than a half of our imports come from China, Canada, and Mexico. So that's why he's starting with those three, because they are our three largest. And of course, he's put the temporary kind of 25-ish% taxes on tariffs on Mexico and Canada. And he's ratcheted China up from 10, which I thought would stick, to 20 because he really means business. Let's not forget that China used to be our largest trading partner before Don Trump number one came along. He put tariffs on a number of imports from China, and that pushed China from, we've literally halved our imports from China over the last decade. They used to be by far our largest trading partner, and now they're down to being our second largest trading partner, just behind Mexico.
Okay. And that clearly didn't hurt the economy all that much because the last 10 years have seen growth, the COVID period notwithstanding. And I guess a little blip in 2022.
Effectively what it's done is, in the simplest of terms, they put a 25% tariff on Chinese imports of furniture. And almost all furniture we were importing a decade ago was coming from China. Now only half of it comes from China. The other half comes from Chinese companies in Vietnam. So they said, all right, if you don't like it being built in China, where can we build the factory and let it come in? It's the same way for auto parts and things like that. There's a huge number of Chinese, companies in Mexico have relocated, I think it's not so bad that they're Chinese manufacturers. That's fine. It's just that we want to make sure we've got access to those parts from an economic security kind of point of view. And I think it's much more likely to get whatever it is we need from Mexico, even if it's owned by a Chinese, employer, than it is if they're over in China in, say, a time of war or a time of bargaining over Taiwan, let's say.
Okay. But bottom line here is you don't think that the tariffs should be a significant enough drag on growth to where we suddenly go into a recession here in the U.S.
It's certainly confusing. And, there's the Cato Institute has a marvelous piece out on exactly what this auto tariff would mean for Canada and Mexico. And it's just even the path of a small little chip that is in a seat to make the seat move crosses a number of international boundaries by the time it gets finally into the car. Almost 6 times it's crossing some type of international boundary. So it's very difficult to figure out how this whole thing's going to be implemented. And of course, the whole idea of the North American Free Trade Agreement was so that you basically have a free trade area where comparative advantages, Mexico, mostly, you can produce auto parts and assemble cars down there cheaper and then bring them back in. But of course, a lot of those parts are coming from China or someplace else, or even an American, firm. So it gets awfully complicated. The bottom line is this, though: how much could it possibly impact the CPI if you put a 25% tariff on Mexican imports, 25% on Canadian imports, 20 on China, like they have? That has the potential to basically quadruple current tariffs from about $80 billion to probably something close to $320 billion of tariffs, and raise the CPI as much as 1.4%. But that ought to be a one-time impact. I will even tell you that can't happen because when you put the tariffs on, we buy less of whatever it is. Just like in China, we bought half as much from China once we made the tariffs more expensive there. And, they will adjust. It will take some time, but manufacturing will adjust to the lowest cost possible place. So we probably will import less, which means we'll earn less tariff, if you will, or less tax. And it will be about half the impact of the CPI as the maximum impact that you could possibly have.
All right. And there's nothing in the outside of the tariffs now, turning just to the U.S. picture and the data that we've seen and the unemployment figures. Today's was okay, the unemployment claims, but last week unemployment claims were a little high. We get non-farms tomorrow. Is there nothing about the employment, the labor market in the U.S. that concerns you?
Well, it ought to concern all of us because we've got two dynamics going on at the same time. Number one, we have literally turned off all immigration. We had over 10 million net immigrants over the last 4 years of the Biden administration, the largest number of immigrants coming into the country ever as a percent of the population. perhaps as many as 70% of those folks could actually work. So there was a huge increase in the labor force, which was the key driver behind the unemployment rate rising from a low of 3.4% to a high of 4.2%. It wasn't like we weren't creating jobs. You know that we were creating jobs all along, but yet the unemployment rate was rising because we had a rapid influx of employees into the workforce. Going forward, literally, we're down to something like 8,000 entrance into the U.S. now from the Mexican border on a monthly basis. So they've literally been just turned off. And we are facing a demographic cliff coming up because during the subprime crisis, our birth rate here in this country declined materially. Over the next 4 years, we are likely to lose about 400 to 500,000 workers who are 18 to 64. In other words, our workforce will be shrinking. So while we've turned off a spigot of new entrants into the workforce, we will also have, from a demographic point of view, people leaving the workforce, perhaps offset by government employees getting fired who will be looking for other jobs. So it's a pretty interesting dynamic. Theoretically, let's put it this way. You should increase the unemployment rate by firing all these government workers, right? At the same time, we have fewer workers coming into the country and people leaving their jobs from a demographic, which will lower the unemployment rate. That's why my forecast basically changed once Trump was elected to basically have flat unemployment. And already it's gone from 4.2 to 4.0, as opposed to slightly rising unemployment under a Harris/Biden, extension of the administration. So it's awfully complicated, but I think they're kind of equally offset situations. Less immigration, but less government workers, perhaps looking for second jobs.
Right, right. And now, so how much longer do you think this economic expansion can continue?
Well, the average economic expansion post Volcker's huge raising of interest rates in the late 70s, early 80s has been 9 years. So we are, we're basically 4.75 years post the pandemic, 4.5 years. So we're literally right in the middle of this, what I always like to refer to as a 5-act play or a Tom Cruise movie, where we're somewhere in the middle, where Tom loses his way. Usually something bad's happened to him. He's run into a wall as a race car driver, or Goose has been killed as he's ejected from the seat. And I think this is our middle of the road showdown with the administration and having to adjust to all of this. Now, to show you how bad I am, I had only projected a 1.5% increase to GDP last year to start the year. And yet we almost doubled my estimate, and my estimate was actually fairly optimistic because people were still looking for a potential hard landing. So, we really have quite a bit of momentum. It's about a 5+% nominal speed adjusted for inflation. That's how you get the 2.8% real growth. We are cooling. All right. So the plane is flying at a slower and slower speed, but it's still cruising faster than it typically does. Real growth from the end of the pandemic, or the end of the subprime crisis, to the beginning of the pandemic, which was almost 11 years, averaged 2.1%. Last year, it was 2.8. The year before, it was 2.9. My guesstimate this year is 2. We're just cooling down to cruising speed.
Very interesting.
And people that are worried about a soft landing, I say we haven't even approached the airport yet.
Fair enough.
We're about to approach the airport. We're about to come within range, yes.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com, or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show.
So it sounds like if we're 4.5 years in, you can see like 4 more years of this potentially of economic growth still.
Absolutely. I would say, mathematically, it feels like we're about halfway through a typical expansion. You never know what ends the expansion. I don't think, the government, objectives here from a top-down perspective are going to end the expansion. It's going to be something we don't see yet, as it typically is.
Right. But there's nothing out there that has you terribly concerned.
Well, I mean, I think I think that you're going to see the markets confused, and so the halcyon days of rising stock prices are likely behind us. The interest rate curve has come down a little bit, but real yields are, normalizing. The 10-year tip yield is north of 2%, which is what it averaged before the subprime crisis. So in other words, you can buy a 10-year Treasury bond and expect to earn 2% more than inflation, which is a very normal kind of rate. So we're not going to have ultra low interest rates to help us along here. So I think the magnificent market setting returns are kind of behind us, and we're going to have to fight our way forward. But that's quite a wealth effect, helping the economy along, offset by higher real interest rates, which will gradually slow the economy just naturally on its own.
So what does an investor do then? What are you advising your clients at this point?
We can start with this. We've had, 2 consecutive 20+% years in the S&P 500. The key factors that were driving those stock prices higher were size and momentum. And of course, that largely accrued to the benefit of those magnificent 7. We do now see, of course, the Mag 7 stocks are down almost 13-14% on a year-to-date basis, and yet the stock market is very, very close to being flat. It was negative. It jumped yesterday. It's close enough to flat, and it's falling today, so it's slightly negative. But we've seen a huge rotation from those narrow, technologically focused companies to the much broader market. One way of thinking about it is you can buy the equally weighted S&P 500 index compared to the S&P 500 index, and it's outperformed the market by almost 10% year to date. So one thing we're telling people to do is to think about diversifying away from those Mag 7, but not so far down in capitalization to get to the small cap stocks, which, honest to God, have had negative earnings last year. Last year, small cap, the Russell 2000, you actually had negative earnings growth. They fell by 7% last year. So I don't think you want to fall to the weakest companies, but you can certainly move to a much more value-oriented, equally weighted portfolio without such a narrow concentration. That's number one. Number two is we've been encouraging people. Now, this is hard to get them to do this, but to buy, just plain old vanilla duration-oriented fixed income as a diversifier. It didn't work worth a lick for the last 4 years, right? Because we went into that with an ultra low interest rate environment. But now we have a much more normalized kind of, expectation for interest rates going forward. And your coupon now at a 4.5% to 5% plus coupon, even 5.5% basically for a core bond fund, is enough to offset a lot of the price volatility. And it is acting as a diversifier. Note year to date, okay, with the S&P 500 down slightly, you have bonds up about 2.5%. So it's finally gotten to an interest rate level where it's acting as what it's supposed to do, a high quality diversifier that takes some of the risk out. The third thing, and we are still underweight international, but I think we're going to have to come to grips with this, is that we've seen finally a spark of rotation towards the international sector because of all the things going on here and the fact that they're stimulating over in Europe, particularly because of the possible defense spending. You've seen, the European stock market, finally bottomed. Japan bottomed, about a year ago, and making some good forward progress relative to the U.S. And there's a little bit of a tailwind here finally because the US dollar, which has been super strong, has finally begun to roll over just a touch. It's down, probably 5.5%. On a trade weighted basis from its peak. So you're getting a tailwind in addition to just European stocks who were priced very cheaply, and to disappoint you, compared to a very expensive U.S. stock market that was priced to, it's trite to say, but to perfection. So you're seeing that type of rotation. Now we're still underweight international. We haven't come to grips with whether this 13-year trend of domestic superiority is going to end, but it feels to me like you better start paying attention a little bit more to the international markets as a diversifier.
Interesting. We've had other guests tell us the same thing, and you are all smart people, and I would not bet against that. Interesting stuff here. When you say duration-oriented fixed income, you mean like where on the curve would you say, like middle or?
We've historically been a bit short because, of course, this ultra low interest rate environment, it made sense as interest rates were backing up. We began to move duration out to neutral, and I did it a little too soon. I got neutral with all of our funds basically about mid-year last year. Now, note that interest rates kept climbing last year, right? So the 10-year Treasury started out 2024 at 3.88%. It ended the year at close to 4.5%. So I was a little too soon pushing the duration out. But now that the 10 years back down to 4.25, it's finally working out. You're never going to time that perfectly, but basically we're telling people don't get short duration here. The Fed is likely to be cutting eventually after we work through this, either policy fog or storm, depending upon your perspective. And they still have their foot on the economic brake. They still have a slight foot on a brake, slowing the economy, slightly restrictive stance. Ultimately, they're going to get to neutral, which is what they want to do. Neutrality is arguably, anywhere from 85 to 125 basis points over trailing inflation. That's that so-called R star, and you're going to see a new dot plot out of the Fed that they're going to tell you what their long-term R star looks like a little bit. But it's clearly rising, meaning that they're likely to continue to have reasonable real short-term interest rates. But we think that at least 2 rate cuts gets them to about 4%, with inflation at 3%. That's spot on neutral until inflation finally works through this fog and begins to slowly decline again, I think, once again in 2026.
So it does sound like you think the next move in interest rates will be lower from the Fed.
Certainly lower, but the 10-year Treasury has been a bit of an overachiever in a sense that it's already discounting a lot of that move and has been. The historic spread, say, between cash and the 10-year Treasuries, much closer to 120 basis points. And so even at 4.25, today's 10-year Treasury, that's kind of discounting a 3% cash rate, which I still think is quite a ways away. So I'm not telling people to get real excited, but what it is it's an insurance policy against an economic disaster or a stock market sell-off. The average stock market sell-off in a year, the S&P 500, is 14.5%. Last year's peak to trough was only negative 8.8% when we had that late kind of midsummer swoon towards the end of the third quarter. So, it's fairly typical. I mean, it is on average. You've got to remember the stock market will fall 14.5% peak to trough on average in any given year. And we're probably starting to work through something like that. When it gets to be 20% is when people worry, is the stock market telling you there's a recession? And the stock market typically tells you there's a recession 2 times during an economic cycle, and it only happens once. It's the second time. So maybe this will be the stock market that scares you into thinking that there's a recession, and yet we still work through it.
Uh-huh.
That's kind of healthy for long-term investors, particularly people that haven't put all their money, that are still earning money. I always tell people that are younger, you should hope for a weak stock market so you can buy stocks cheaply. But, it's still a very expensive market, even today. We had 13% earnings growth last year, but we had 25% return to the stock market, which meant basically half of the return last year was just a multiple expansion. And going forward, you're not going to continue to get those multiple expansions. It's going to have to be, at best, driven by earnings. Earnings could be up as much as 10+% this year. They're up 13% year over year last year. But, you're facing that multiple expansion and some worry going on because of all the administrative policy that we have to adjust to.
Right. I want to ask you one last thing about this. The Atlanta Fed has something called the GDP Now. Are you familiar with that?
Absolutely.
Yeah, it attracted a lot of attention last week because it suddenly, kind of out of nowhere, signaled a negative first quarter GDP print. And the market kind of reacted to it. And I'm wondering if you've looked into this, how valid it is, yeah, what your thoughts are on that.
Well, two things. Number one, it's quite possible that we do have a negative print. This
Hmm.
negative print in the first quarter will be driven by two factors. Number one, easiest to understand, is the horrible weather that we had January to February. Look at your heating bills if you're in the Midwest or Northeast or wherever. And we had, some tough weather that basically holds back what? Building, construction, consumption, everything. But number two, and this is the big driver of the negativity, is remember an import is a negative to GDP. So when we import something that subtracts, when we export something that basically pushes up your GDP. Everybody is front loading their imports. Every manufacturer, every retailer, everybody that's got anything coming in from overseas has tried to get them on the boat and get them into the country to beat the tariffs.
Yeah.
So you're front loading your inventory, and basically those imports act as a subtractor. That will quickly reverse in the second quarter as people aren't going to continue to build their inventory and then add to GDP in the second quarter. So what you're going to see is a big swoon.
Mm.
In January, basically at the end of February, early March, we get the January import statistics. The GDP now is basically annualizing those same things that happened in January through the entire quarter. I think it will slow down. It's not going to be as bad as the GDP now forecast is, but it could very likely be negative. Don't let that scare you into a recession. It's the math of the situation and a bounce back in the second quarter.
Oh, that is so interesting. Wow, what a great conversation, Scott Colbert. Thank you again for joining us and clarifying all of these issues and hopefully many questions that people had. I know my mind is a lot more at ease now. In closing, maybe tell us how listeners can find out more about you, more about your firm, where to read your stuff, and things like that.
Well, Commerce Bank is a Midwest bank. We're about the 40th largest bank, about $8 billion in market cap. A lot of our business has to do with fee-based revenue, which is the money management arm. So we're about a $70 billion money manager. Basically, domiciled here in the Midwest. Offering a fairly typical stock, bond, balanced portfolio, and a modest amount of alternative offering. It's a high-quality bank, and basically been around for a very long time. The bank likes to say it was invented 185 years ago. It's hard to know, what it was like back in the 1900s, but we've been around for a long time. Offering a stable of investment opportunities. CommerceBank.com is the website you can go to and then find out all the things. Commerce Trust is the name brand of our money management arm. I do put out about a 5-minute. I try and keep it to 5 minutes. Put it out about every 3 weeks to talk about the economy and what's going on. We also have podcasts and research and things like that that you can get on our website. I think it's important to note that as a bank, and I didn't know this, I've been there 31, 32 years, and I didn't know this has really helped me. But as a bank, we get to see the economy in real live action. I'm sitting here in Kansas City, just came over from St. Louis, meeting with Midwestern, middle-sized companies. And what I would tell you is the business community is very healthy. The consumer, on the other hand, that benefited greatly from the massive amount of government stimulus is getting back to a more normal situation. In other words, credit card delinquencies, which were ultra low, are beginning to get to normal. Car loan delinquencies, which were ultra low, are getting back to normal. But business delinquency, because they're so healthy, in such great shape, basically is almost literally non-existent. So the economy is still, from a banking perspective, we're still well into the first half of the expansion rather than the back half where you're watching, charge-offs and delinquent loans rise. I don't doubt that they will be rising over the back half of this economic expansion, but we're still in a very favorable point. The banking industry itself is exceptionally well capitalized, with charge-offs very modest, with the niche players that have focused on commercial real estate, still working through those troubles. But other than that, it's a fairly healthy business community and a very healthy banking and financial world out there.
Very interesting. Awesome. Scott Colbert, thank you again for joining the Contrarian Investor podcast. I'll put all that information in the show notes for you. And with that, we thank you all for listening, and we'll see you back here again, probably in a week or less. Speak then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.